The section begins by demonstrating the differences between a mortgage and a note, and distinguishing between lien theory, title theory, and intermediate theory states. Next, we will identify the lenders who comprise the primary mortgage market, provide a brief history of why the secondary mortgage market was created, and conclude with a discussion of the Federal Reserve. At the closing table, a borrower of real property will be asked to sign a mortgage. The mortgage is a pledge of property to the lender as security for the payment of the debt. The mortgagor is the borrower giving the pledge to the lender. The mortgagee is the lender receiving the pledge.
The borrower will also sign a note. A note is the evidence of debt and states the amount borrowed, the interest rate, and loan terms. In a note, the borrower is making a promise to repay, so the borrower is the promisor and the lender is the promisee. Sometimes the borrower is also called the obligor and the lender the obligee.
When recorded at the courthouse, a mortgage is a voluntary lien on the property. The rights that the borrower gives the lender in the mortgage document are determined by state law. States are classified as lien theory, title theory, or intermediate theory states. Remember, a lien is a legal right or interest that a creditor has in a person's property, whereas the holder of a title has the right to control and dispose of the property.
Most states are lien theory states that give the lender a lien interest in the property. This means if the borrower defaults, the lender would foreclose through a judicial sale.
In title theory states, the lender would hold title to the property. Because the lender holds the title, the law interprets the lender as owning the property until the final payment is made. A deed of trust, which is also known as a trust deed, is the security document used in many title theory states. Here's the process. Remember, a trust involves three parties: the trustor, trustee, and beneficiary. At the closing, the borrower, who is the trustor, signs the deed of trust and gives legal title to the trustee. The trustee is usually a title insurance company or an attorney who holds the title for the beneficiary, the lender. The borrower retains equitable title to the property. Remember, equitable title is an insurable title and gives the holder the right to acquire legal title in the future.
Once the loan has closed, there are two possible scenarios. In the first scenario, the borrower makes the monthly payment to the lender and pays off the loan. When the final payment is made, the lender informs the trustee and a deed of reconveyance is used to reconvey title to the owner.
In the second scenario, the borrower defaults on the loan. Here, the lender would notify the trustee, and the trustee would send the proper documents to the trustor, who would give them an allotted time to make the payments current. If the payment is not made, the trustee would sell the property through a non-judicial foreclosure procedure. This is also known as foreclosure by advertisement.
Intermediate or mixed theory states are based on the principles of title theory states, but the lender must foreclose to obtain the title.
Now that we've reviewed the possibilities of the lender's interest in the property, let's continue with the primary mortgage market, or the local finance market, made up of lenders or intermediaries who originate loans and make funds directly available to borrowers.
Savings and loan associations, commercial banks, insurance companies, pension funds, credit unions, mortgage brokers, and mortgage bankers make up the primary mortgage market. Savings and loans, or S&Ls, may be state or federally chartered. Historically, these lending institutions specialize in accepting savings deposits and originating conventional loans made to borrowers who purchase residential property. Savings and loans are often mutually held, meaning depositors and borrowers are members with voting rights to determine what happens within the association.
A commercial bank is a type of financial intermediary that raises funds by collecting deposits from businesses and consumers via checking deposits, saving deposits, and time deposits. Commercial banks negotiate loans to businesses and consumers as well as buy corporate bonds and government bonds. A commercial bank's primary liabilities are deposits because depositors can demand their money at any given time, and their primary assets are loans and bonds.
Insurance companies invest in long-term real estate projects. Insurance companies prefer to negotiate loans on income-producing commercial and industrial projects, and they frequently demand to be allowed to participate in the borrower's investment before they will negotiate the loan.
Pension funds channel funds through mortgage bankers and mortgage brokers by negotiating first and second mortgage loans.
A credit union is a cooperative association that offers low interest rate loans and other consumer banking services to members who share a common bond. Historically, credit unions made short-term loans, but they are beginning to make long-term real estate loans to their members.
Mortgage bankers are companies that have money to originate loans. They do not offer checking accounts or other services of a retail bank or a savings and loan association. Mortgage bankers originate, process, underwrite, close, warehouse, package and sell loans, and service loans. Mortgage bankers are usually subject to fewer restrictions than commercial lenders.
Just as a real estate brokerage firm is the middle person between the buyer and seller, mortgage brokers act as financial middle persons between borrowers and lenders. Mortgage brokers do not have their own money to lend. Instead, they represent lenders and charge a finder's fee for their services.
The lender's profit is derived from finance charges and recurring income. Finance charges include origination fees and discount points, while the recurring income is the interest collected on the loan.
An origination fee is charged for the services rendered when originating a loan and is computed as a percentage of the loan amount.
Discount points are charged to increase a lender's yield. The discount points may be paid by the buyer or seller and are computed on the loan amount. If the lender charges 1 point, that means 1% of the loan, 2 points equals 2% of the loan, etc. The formula used for computing discount points is the loan times the discount points as a percentage equals the discount points in dollars.
Interest is the charge for the use of money. Think of it this way. When you go to the bank to negotiate a loan, you're renting money, and the interest charged is your rent payment. The interest paid on a real estate mortgage is simple interest, meaning the interest is computed on the loan balance. When you place money in a savings account, the bank pays you interest because you are allowing them to use your money.
This concludes this section. Please close this page to continue with the next section.